Hey everybody, welcome back to Firm and Final. A quick 5 minutes of what's going on in the stop loss industry. And for today's topic, we're going to talk about that four-letter word, that really bad word, laser. I know, it's 5 letters. I get it. But in our industry, it's considered a four-letter word because it's such a bad thing. So what is lasering? This is the concept of, at the time of underwriting, when you find an individual that's got a known condition or is expected to have a high cost event in the policy year, the stop loss carrier or the reinsurer will either set a higher deductible for that person or they'll completely exclude them from coverage. And yes, that happens in our industry. It actually happens quite a lot. And you're probably wondering, like, why is that allowed to happen? Well, the concept of setting additional expense or additional liability or even excluding coverage, that happens in insurance. It happens in life insurance. Think about it. People who are smokers, they can either pay a higher rate for life insurance coverage or they can't get coverage at all. In auto insurance, if you're somebody who's had a DUI, or you have a history of speeding and you've gotten a lot of speeding tickets, you may pay a lot more for auto insurance, or you may not be able to get it at all. And unfortunately, if you think about property insurance, it's a similar situation in property insurance when you think about what's going on in Florida right now. With all those hurricanes that have happened in Florida, there's a lot of insurance carriers that view that area as being a higher level of risk. And so if you live in a certain part of Florida, you may not be able to get flood insurance because that area is known to have more hurricanes. So that concept exists in insurance. We see lasering happen a lot in stop loss and reinsurance. In fact, I would tell you, I think it's happening more and more, and I think it's going to continue to happen more and more. And the reason for that is if you look at the marketplace is roughly $40 billion, but it's made up of roughly 100 stop loss carriers. And you get to that number 100 when you add up all the different regional health plans that provide stop loss coverage, all the specialty third party carriers that provide stop loss coverage, and then all the MGU carriers that are either partnered with a reinsurer or an MGU that are in the marketplace. When you add them all up, there's about 100 different carriers in this space. And everybody is competing for a piece of that $40 billion industry. Now, if you look at like the top 10 stop loss carriers, they make up almost 80% of the market, which means everybody else is going after that other 20%. And in order to get your fair share, you have to look at several cases. And when you do that, you want to make sure that you're not walking into known risk because your share of the pie is so small that you can't subsidize that exposure. And so, because of that, we see a big part of the stop loss industry and the reinsurance industry needing to use lasers. If you look at the loss ratios in this industry, they have been creeping up for several years. And according to the Aon study, loss ratios have actually dipped down in 2023, but they've been above 80% now for a couple of years, which means after you pay premium taxes, after you pay your MGU fees, your underwriting fees, your carrier fees, after you pay the broker commissions, there's not a lot left. So when you really squeeze down the profitability, your next kind of lever to ensure that you're profitable on the business that you write is to exclude high cost claimants from coverage. So this is a trend that's in our industry today. I think it's a trend that's going to persist. It's something to keep an eye on. Unfortunately, right now is the time in the January 1 cycle where cases are firming, and so you're going to see this used more often. So that's it for this week. We'll see you next week.